Well, it's hard to believe we've reached the midpoint of the year already. We're into July. I hope your summer is off to a good start and you've got some great and some fantastic holidays lined up to spend time with family and friends. I know with my team, the holidays are underway. My assistant Joanne just got back from a bucket list trip to Italy. Kathy was earlier this year, she was in the UK. Cynthia has time with her family at their family cottage. And my associate Jack was the best man at his sister's wedding. And I suspect the quality of that young man, that will be not his only opportunity in his life to be the best man in somebody's wedding. Later this month, I'm off for my holidays to spend time at my in-laws' family cottage up north. It's a place that's near and dear to my wife, and I get great joy out of seeing the pleasure that she gets spending time back there, reliving her childhood. So now back to the markets. It's been a busy start to the year. Lots going on. Let's take a look at what's happening in the markets. Just sharing my screen here. All right. So as we get underway, let's look at the performance of the markets year to date. So when we look at the S&P 500, or sorry, the TSX, year to date for the first 6 months of the year is up 4.38%. Over the trailing 12 months, closer to 10.5. However, the US markets continue to be the dominant player. The S&P 500 index in the first 6 months of the year is up almost 15%. The trailing 12 months, 23%. It is really being driven by big cap, large technology companies, which is evidence in the performance of the NASDAQ Composite Index. Year to date, the NASDAQ's up almost 20%, 19.1%. However, trailing over the last 12 months is up 30%. That's stark comparison compared to the Dow Jones Industrial Average, which does not have the same exposure to those large tech names. The Dow is up just under 4% year to date, actually underperforming the Canadian market year to date. Over the trailing 12 months, up 13, almost 14%. When you look at the big picture, the world, less the US, the world stock markets on average are up 1.6% year to date, and the trailing 12 months is 13.4%. The Chinese Shanghai market is down about 6.5 over the last 12 months. France is relatively flat year to date. Germany is up about 9.2%. Italy, Japan, solid returns. UK up about 5.6. Australia's been a little bit quieter, and India has done exceptionally well. Crude oil up strongly, natural gas up strongly. Gold has had solid performance year to date, up almost 10%. However, silver has doubled that. So what I want to talk about is a little more exposure to the breakdown of the S&P 500 index. Why is it outperforming the other indexes as a whole? So when we look at it, this is a chart that shows the correlation of the top 10 stocks that make up the index. And so what we're seeing here is the top 10 stocks. So in the S&P 500 index, it's a basket of 500 stocks. 10 of those names represent over a third of the value of that index at 37%. However, they only contribute 27% of the earnings. And this is really how it's playing out. If you look at the chart here on the left, that green line, that is the performance of the Magnificent Seven stocks. That includes Apple, Nvidia, Microsoft, Google, Facebook, Amazon, and Tesla. So those 7 names, as you can see, over the past few years is up roughly 200%. The blue line at the bottom is the performance of the S&P 500 index, excluding just 7 names. So the remaining 493 stocks are up about 120% over the last few years. With them combined, it's closer to about 150%. So as those 7 stocks go, they are large, they are big names. When you look at Apple, Microsoft, NVIDIA. Each one of those names on their own is roughly larger than the entire Canadian stock market. So when we look at valuations going forward, if you exclude the top 10 names, those 7 plus the next 3 largest that happen to be in the tech area as well, valuations actually look cheap on the market. When you look over the last 10 years, the S&P 500 equal weight index is actually trading slightly below its 10-year price earnings average on a 12-month basis. So it certainly does not appear to be that there is a market bubble here in terms of valuations. But it isn't a presidential election year. So in presidential election year, there's a lot going on in the media. Biden did not have a good debate the other night. Has thrown the Democratic Party into a bit of a chaos following that. This chart shows you the performance of the S&P 500 in election years. The red line coming across here is basically what it is year to date compared to other presidential election years. But one thing that we caution people is that in election years, as we get closer to that election, that US election is Tuesday, November the 5th, as you can see, as each month goes by, historically, volatility increases going into that election in November, and then it typically falls off a little bit when we know who and what party will run the White House following that election. Looking forward, this is important following what's been going on in the markets. At the halfway point, where we are today, the US market is up 10% at the middle of the year. So one of the things we like to do is take a snapshot of, well, what should we be doing in a solid year when markets have been performing well? There's a tendency for people to think, well, the market's doing well, maybe I should lighten the load a bit in my equities. This chart actually shows otherwise. When you look at the year-to-date return down on the left-hand column, for sure, the next 3 months we could see some choppiness. We could even see a little bit of choppiness throughout the balance of the year, the next 6 months. That coincides with an increase in volatility in the market with the US presidential election. But look at that column on the right, a full 12 months later, so that would take us to this point next year. You'd be hard pressed to argue based on history, based on historically how the markets have operated, that the best is potentially yet to come. But there's going to be some patience required over the next 3 to 6 months, with the US election and looking down the road. Here's another thing we like to talk about. When we're looking at markets, we do now and then get questions about saying, Chris, Jack, the markets are trading at all-time highs. Should we be selling? Is this the time we should be investing new money? This is an interesting chart from a standpoint of investing on any given day, those gray or black lines. But what would performance be like if you invested when the market started to make a new high? And look at that. That is a very significant outperformance in almost every case, embracing when the markets are doing well, following the markets higher. This next chart shows just exactly that. Look at the performance you would have missed. All of those green dots are times that the market made new highs. What would happen if you sold, lighten the load on equities as the markets were making new highs? As you can see, this is going back to the 1950s. Of course, there's been some challenging times during that period of time over the last roughly 75 years, but that chart is marched pretty solidly from the bottom left to the top right-hand corner. We also have a bull market checklist that we look at. What is our current reading? What is the criteria? At the end of the day, the criteria shows well. 9 out of 9 of our bull market behavior checklists are in the yes column. So this is favorable for strong market activities. Earnings are the key driver for markets. Ultimately, how much money these corporations make is what drives their share prices higher. This is what, looking out over the next 12 months, the earnings forecast is for the S&P 500. As you can see, it certainly looks strong through this year and beyond. When we look at 2025, we see earnings continue to grow past 2024. But what we're actually seeing here for the first time is that the largest contribution to earnings and the biggest growth to earnings is coming from the small cap companies. What about a broader outlook on the market? You know, this is one of the things that we've talked in some previous videos is the direction of interest rates. It's been long believed that interest rates are going lower. However, it's come at a much slower pace. Cuts in rates have not happened at the same pace as what they were expected to happen. The economic activity in Canada and the US remains strong, stronger than most people anticipated. And as you can see by that top chart, that the gray line at the bottom was what the forecast was going back a little over a year ago, where rates would be. The line at the top, that blue line, is kind of where it looks like it's going to be now as we look further out over the next 12 months. And as you can see, there is not a significant decline in rates forecast at this point in time, but they are expected to go lower. One of the interesting thing about rate cuts is markets tend to do well when the end of interest rate increases happen, the end of that rate cycle hike. So this gives you a picture of what it looks like where we were just kind of a month or so ago, and kind of what the expectation is as interest rates continue to come down. One of the big topics we always talk about is, inflation and deflation in Canada. We're really talking more about today on the right-hand side, those inflationary costs. And as you can see for Canadians, that mortgage interest has a significant impact on their household, followed by home insurance, followed by rent. But when we look at the other side of the column on the deflationary aspect, there are actually some things that are getting cheaper. Telephone services, books, internet access, natural gas, clothing. Vehicles have come down a little bit, appliances have come down a little bit, but overall, the inflationary is larger than what the deflationary forces are. Household debt in Canada is significantly different than that in the US. As you can see, our debt service ratio following the pandemic has risen more than what it has in the US. And some payment shock is coming for Canadians on their mortgage. That's no surprise. 37% of Canadians or households own their home with a mortgage. 32% of households own their home without a mortgage. 31% of household rents. Of those mortgages, just about 40% have yet to reset to higher rates. So there is a shock that's coming to the system with those increased payments. Canada and the US has some diverging trends. Real consumer spending in Canada is tracking less than that at the US. But the chart on the right is really quite staggering, and that is population growth in Canada compared to the US versus the 5-year rate of change. So you can see that the population growth is about 2% a year in Canada, where the US is closer to about 0.5% a year. So the Canadian population is growing at about 4 times the rate of our southern neighbors. I'll just close. One of the things we talk about today is more than ever is artificial intelligence. It's in every newspaper, it's on TV, you see it in your social media accounts. This is an interesting chart talking about those artificial models, and they are improving at each year. What's interesting to me is the rate at what they're improving and, what the human baseline is. So you go back over 10, 12 years, image classification is now better than the human baseline. Visual reasoning is better. Medium level reading comprehension is now better. multitask language understanding is at that same level. And closing the gap quickly is competition level mathematics and visual common sense reasoning. Also, look how fast these models are adapting. This is going to be a big player. This is going to be have a big impact in the future. I want to thank you for taking the time to be here with us today and get your market update. As always, we welcome you the opportunity to reach out to us, ask us any questions that you may have. We wish you the very best this summer to have a safe, healthy, and happy summer with your friends, family, and those that we value so much this year. Thank you. Take care.